Good afternoon, good evening, and early good morning, depending on where you are. I am saying greetings from Tokyo. My local time is time, so I do feel the pain of our audience from Asia this time firsthand. So hopefully at some point I can organize some special lectures that are more Asia. My name is Jun Yang. I'm the director for Kelley Institute for Corporate Governance. And Kelley ECGI was founded in 2000. Let me control my screen a little bit better. And our mission really is focusing on research. So we want to conduct and disseminate high quality research and to advance our understanding of corporate governance issues, including both the classic issues as well as the new challenges and opportunities faced by corporate governance scholars and practitioners. A series
Hello, everyone. I think we have some issues with the connection for June from Japan, so let me take over. I think what she was going to say was that the Indiana University has launched this governance workshop. There's other topics coming up in the next few months. We'll show the calendar at the end. Meanwhile, let's proceed with the presentation. My name is Fabrizio Ferri. I'm the moderator. I'm a county professor at the University of Miami working on shareholder voting. And that's the topic that Nadya Malenko will talk about. Nadya is a well-accomplished researcher from Boston College, PhD at Stanford, published extensively in a lot of areas in governance, in empirical research and theoretical research. I see June is coming back. And so while she shares the slide, I'll just continue to say a few words about Nadya. She's a ECGI member, MBR fellow, I think, and many other great accomplishments. She's also a very, very nice person, very good friend. I'll share just a couple of stories before she starts. One is that, we bonded a while ago when I was a discussant to a paper in a conference in Oregon, where they take participants to boats on the river, and you have to throw water at each other. So we are on the same boat. So we bonded while trying to survive that experience. And then I'm also grateful to Nadya because, I think a lot of my empirical findings in shareholder voting are what I call the empirical findings in search of a theory. There are some kind of empirical factoids, and she was the one able to provide a theory and a framework for many of them. So in that sense, I think she's made my own research more relevant, more impactful, and give a sense of connecting the dots of the things I've done. So I'm very much looking forward to the topics that she will cover today. And I see we have the slides back from June, so I'll give you June again for a moment.
Thank you for helping me, Fabrizio. So this is the scenario that hasn't happened before, but the Tokyo hotel internet is not super reliable. We have hosted 17 lectures in the past, started from the traditional board of directors, CEO markets, CEO compensation. The next lecture next month is CEO activism. And then we started from the shareholder side, we'll have the hedge fund activism indexing. Today we have shareholder voting. And then we have two legal scholars covering insider trading, white collar crimes, and we covered corporate culture and the more recent topics. This is the conference I'm attending in Tokyo, ESG related issues. So we cover ESG, sustainability, greenwashing. This is in December, climate risk. And lastly, but not least, we cover data technology, data ownership, cybersecurity, cryptocurrency, and blockchains. So all our lectures are recorded. They're available on our website. So next month is CEO activism, and then we have greenwashing and ESG investing at a crossroads. So please take out your device. I'll leave this slide for maybe 25 seconds. This is for our next lecture, which is very new line of research, CEO activism. So when the CEO made some statement publicly, what would be the impact on the companies? So that's kind of our next lecture on November 9th. All right, so I'm going to introduce really briefly our moderator today. Fabrizio is a friend. I've known him for his research from about 15 years ago. He's one of the first one to study voting. So he's a professor of financial managerial accounting at Miami, Herbert Business at University of Miami, and his research focus, corporate governance, and with particular emphasis on shareholder activism, boards of directors, and executive compensation. He is a co-director of the Governance and Principled Leadership Research cluster, and his research has been published in top accounting and finance journals and mentioned in prominent news outlets such as New York Times, Business Week, Forbes, Barron's, Washington Post, and so on. So he is a research member of ECGI. I'm also, and Nadya is also a research member of ECGI. And prior to Fabrizio's current life as professor, he was also a consultant on the compensation side, executive pay and performance measurement. So I cannot find a better moderator or a better speaker for today's topic. So Fabrizio, now it's your turn to introduce Nadya.
All right, and do a more proper introduction now of my good friend Nadya Malenko. She's a professor of finance at the Carlos School of Management of Boston College, got her PhD from Stanford. She's a research associate at the NBR, research fellow at the CEPR, and research member of the European Corporate Governance Institute. Her work spans the areas of corporate finance, corporate governance, as well as private equity and organizational economics. Well published in top journals with important awards such as the Journal of Finance Distinguished Paper Braddock Prize. Her research has been covered by the media. I think she's one of those researchers that can do theory work and paper work with policy implication, with practical implication. And she's an associate editor at JF, JFE, and JFQA. She keeps busy. She serves on the board of directors of AFA, WFA, EFA, FMA. You all know these acronyms. These are the most important associations in finance. So Nadya, the floor is yours.
Thank you very much, June, for inviting me, and thank you, Fabrizio, for two introductions. I like the first one with the stories more. Let me share my slides. Okay. Yes, thank you again, and thank you all for being here. So I will start with a few just notes about today's lecture. It is based on a literature survey that we're writing with Alan Brav and Nadya Malenko, and it's in progress, but we hope to make it available in a couple of months. Another note, it's a very large, fast-growing literature, so while I'll try to cover many papers, I will certainly not be able to cover many of them given the time allotted, so I apologize in advance. The slides will be posted, and while I will not be going into detail into specific papers, there will be links to the papers that talk about specific results I'm talking about. And finally, due to limited scope of this lecture, I will focus on voting in the United States in this lecture. There is substantial heterogeneity across countries. This lecture will be focused on the US. So what I will start with is just by showing you a typical shareholder meeting, and start with some general background about institutional details of shareholder voting and some statistics. Then I will discuss the two key roles of shareholder voting, and then I will conclude and offer some directions for future research. So this is how a typical so every year shareholders vote on a variety of issues, and this is, for example, an excerpt from Apple's proxy statement this year, which contains the proxy card that is delivered to shareholders to vote in Apple's annual meeting. And you can see first, shareholders vote on directors. There are 9 directors up for election this year, and shareholders have a choice to vote in favor, against, or abstain. And there are 3 more proposals put forward by management. One is a vote on the auditors of the company. The other is a vote on executive compensation, and another vote on the frequency of executive compensation votes. In addition, there are 5 shareholder proposals where the sponsors was a shareholder. 2 of them concern more corporate governance issues. They concern how much the board should engage with shareholders and the sponsors of the shareholder proposal following the vote, and a proposal related to proxy access, and 3 more proposals related to various social issues. So what I will do next is just show you in general how these typical meetings look like, what proposals are, and what the support rates are. And I would like to thank our great student from Duke, Ellen Longman, who is helping us with the data. So this is the data I will present will be just for 1 year, 2021, which is the latest data we have that we have already cleaned up and merged with CRISP. The sources, ISS Voting Analytics, the standard data set that I will talk about in a few slides. So this year, we have about 4,000 firms and about 30,000 proposals. So that's about 7.7 proposals per firm. Now, if we look more closely what these proposals are, the vast majority of these proposals are sponsored by management, as you can see. And moreover, the vast majority are director elections. So every company has its directors up for election. Most of them will be up for election every year. So that forms a large majority of proposals. Another large category of proposals are say-on-pay proposals that you also saw on Apple's board. Since 2011, most companies have to have a vote on executive compensation. This is an advisory vote. It's not binding for management, but companies need to have it. Most companies have it every year. And then there are a variety of corporate governance-related, board-related compensation proposals put forward by management, as well as some more routine proposals such as auditor approval. And what you can see in these numbers, the support rates for these proposals put forward by management is pretty high, both for proposals in total and for each of those categories, director elections, say-on-pay, governance, and the pass rate, the probability that they pass the required threshold is also very high. The second category are shareholder proposals sponsored by management. In 2021, we have 421 proposals that were voted on. They are only in 250 firms, so many firms get to have, larger firms tend to get more shareholder proposals, again, like we saw in Apple. And actually, this number has been increasing over the last couple of years. So it's more than 600 in 2023 proxy season. And the support rate for shareholder proposals is significantly lower than for management, 44% on average, only 33 percentage point pass rate. Now, one thing to keep in mind when we think about comparing these shareholder proposal and management proposal support rates is that most shareholder proposals are non-binding, and similarly, say-on-pay proposals put forward by management are non-binding. For non-binding proposals, what really matters is the actual support in terms of the percentage of votes that management gets, and not so much whether the proposal passes 50% threshold. And often for non-binding votes, support for management less than 75% is considered to be quite meaningful and often leads to responses from management. So this is something to keep in mind when we see those numbers. Another thing to keep in mind is the selection of proposals that are voted on. So specifically for shareholder proposals, and they are not, right, so many proposals are not put forward by activists. And this is why, because management and shareholders, especially its major shareholders, are in constant communication. And especially this has been shown in a recent work by Alon Brav and co-authors in the context of proxy contests, proposals where management feels that it's not likely to get the support from its major shareholders are much less likely to ultimately get to a vote. The management often settles with the activist in the context of proxy contests, but that applies more generally to shareholder proposals as a whole. So that's something also to keep in mind, that when we think about shareholder proposals, these are the proposals on issues that probably are not majority supported by the firm's major shareholders. Otherwise, probably they might have already been implemented by the company. And there are a couple of interesting papers I list here also about the selection of proposals, which proposals are withdrawn, which are settled, and so forth, that you can look at more closely. So these are the standard proposals. And then another very important category, there's also proposals on mergers that sometimes happen. Another very important category of proposals that are not in this data set are proxy contests. So there are about 50 to 80 proxy contests, contested director actions that take place every year. That's when there is an activist investor that puts forward an alternative slate of directors, or maybe a couple of directors that this dissident wants to put on the management, on the board of directors. These are much more contested than the typical director elections, when the number of nominees equals the number of board seats, and that is reflected in the voting outcomes. So what you can see in this picture, these are the numbers from the paper by Brave et al. There is also a paper by Slava Foss with related statistics, is that for proxy contests that proceed to a vote, they are very close. 15% of them, right, about half of the proposals that proceed to a vote are won by management, another half is lost by management. And as a result, because they are so close, also a lot of proxy contests are indeed settled by management in advance. So when management sees that it's unlikely to get the support of its major shareholders, it may settle with the activists beforehand. And in Alon's and co-authors sample, it's about 49% of proxy contests that are settled. Another 20% are withdrawn. That's probably when the activist feels they're not likely to win this proxy contest. So this is a summary statistics. Let me now talk about where the votes actually matter. There are two categories of votes, as I alluded to before. The binding votes bind the management. So if the proposal receives the support or that exceeds the required threshold, the vote, right, the proposal has to be accepted. Votes on mergers, so for the target shareholders, if they vote on whether to be acquired or not, are binding. Proxy contests, large share issuances, including in the context of acquisitions, are binding. And there is research showing that these binding votes actually matter. For example, in the context of acquisition, when shareholders actually get to vote on acquisitions, that doesn't always happen, but they get to vote under certain conditions, then those acquisitions tend to be associated with higher abnormal returns for acquiring shareholders, so there is less overpaying. Proxy contests are associated with large abnormal returns around proxy contest announcements. And what we also see that has been documented in a number of papers is that management is taking active actions to increase shareholder support, which also signals to us that these votes matter and the outcomes of the vote matter to management in particular. The second category of votes are non-binding. For these votes, even if the proposal exceeds whatever threshold they're not, or 50%, they're not really binding for the management. It has discretion over whether to accept this proposal or not. Most shareholder proposals are non-binding. Executive compensation, the say-on-pay votes that are required for public companies are non-binding. And director elections, they used to be mostly non-binding. Now they are often non-binding to a large extent as well, depending on the resignation policies that the company has in place. So do non-binding votes matter? If the management doesn't have the requirement to implement those proposals, do they have an impact? And Fabrizio has a very nice review paper about this low cost, right, of essentially non-binding shareholder activism that summarizes the evidence, and it suggests they do have an impact. I have earlier theory work with Daron Levitt, in which we show that these proposals are likely to have an impact, specifically when the management faces some consequences for ignoring a shareholder vote. And in practice, indeed, firms that are not responsive to non-binding but majority supported shareholder proposals, they do face consequences. Shareholders don't like management that is not being responsive. proxy advisory firms, I will talk about these companies later, very influential companies that also affect how shareholders vote. They don't like when management is non-responsive. So there are these consequences. More specifically, in the context of director elections, research has shown that low support for directors is associated with decreased CO pay, increased CO turnover and performance sensitivity of turnover, and the rate of responsiveness to the concerns that are expressed through director elections is more than 40%. Earlier research didn't find a lot of labor market consequences, but a recent paper by Agarwal and co-authors showed that indeed directors now do face labor market consequences, both internal in terms of their positions on the board and also in terms of their external bosses. In the context of say on pay, Fabrizio and others have looked at the consequences of companies receiving low support for say on pay proposals, and 55% of firms respond to low say on pay votes by reporting compensation changes in the next year. And moreover, we also see spillover effects on peer firms. Even peer firms that didn't receive a low say on pay vote, they start preemptively taking actions to prevent a low say on pay vote for themselves. And this preemptive behavior has also been observed by a paper by David Larker and co-authors. It shows that often companies take certain actions to adjust their policies to the way they that shareholders and proxy advisors like them to be, to avoid these low say on pay votes. Finally, in the context of shareholder proposals, earlier research did not find much that they have an impact. And John Karpov has a nice review paper summarizing this earlier research. But in more recent years, since 2003, especially many mutual funds became required to disclose their votes, and also there was a fiduciary duty imposed on them voting in the best interest of their clients. In more recent years, we see even shareholder proposals having an impact. So in the samples that try to estimate the implementation rate, post-2004, there was about 70% implementation rate upon majority support. That's the paper by Bach and Mezger. And the paper by Vishwendra Kunat and co-authors finds positive abnormal returns to the acceptance, to beating the majority threshold in close votes to get around various issues in estimating the price reaction. So it seems overall, even the non-binding votes seem to matter, both for policies and for the value. So let me talk a little bit about how corporate voting stands in the context of other corporate governance mechanisms and as well as other engagement channels by shareholders. So this table is from the survey of large institutional investors by Laura Starks, McCaughery, and Sotner in 2016. And this survey shows that voting against management is essentially the second most frequent used channel of shareholder engagement. 53% of respondents use it as a measure of shareholder engagement. And then a few others related tactics that I emphasize here also related to voting: criticizing management at the annual meeting, publicizing their dissenting vote, and certain asset managers submit shareholder proposals for the meeting as well. What is another interesting thing to look at is how voting fits in the context of corporate governance mechanisms as a whole. And here I will list some governance mechanisms and also give you a link to some previous ECGI lectures that you might be interested in watching if you're interested in this topic. So one main mechanism, important mechanism is shareholder monitoring. And usually we think about voice and exit as two key methods of shareholder monitoring. Well, voice is all about voting. It's voting or it's communication, but for communication and engagement to be effective, ultimately, the threat of voting is often very important as well. The second governance mechanism is the board of directors. And as we know, shareholders vote on director elections. These votes do have an impact even for regular director elections and especially for contested director elections. Executive compensation. Since 2011, public companies are required to have a vote on executive compensation. And as we saw in the previous slides, these votes do affect how companies respond with their compensation packages. And finally, the last important corporate governance mechanism is the market for corporate control. The threat of a takeover by another company, or the threat of an activist intervening, starting to take some, running an activist campaign or a proxy contest. And in the context of a takeover, the shareholders of the target are always have the right? They're always voting on whether to be acquired or not. In the context of proxy contests, shareholders vote. So you can see voting fits very much in all of these corporate governance mechanisms. If you're interested in voting, what kind of data can you use? What kind of data researchers use for this? So first of all, if in terms of overall voting outcomes and what proposals are on the table, all companies are required to disclose within 4 days after the annual meeting the outcomes of the vote in their Form 8K. So this is the 8K form for Apple that I showed you before. And ISS Voting Analytics, that's the standard database available to researchers that summarizes this information and is often used. One thing to keep in mind, if you want to study proxy contests, they are not covered very well in ISS Voting Analytics. So for that, you would want to go and manually collect the data from 8Ks, as well as these researchers have used other databases such as Chuck Repellent and 10K, 10Q firms. In addition, ISS offers another data set, which is shareholder proposals data set. So that data has more details on shareholder proposals, including some proposals that even did not proceed to a vote. If we want to study the votes by individual shareholders, since 2003, mutual funds are required to disclose their votes in NPX forms. And this is an NPX forms for BlackRock fund in Apple for that meeting that I showed you. Again, ISS Voting Analytics collects this data, and this data is available for researchers. But if you want to use it for proxy contests, that's not great. So Bravo and Al have collected this data manually from NPX forms, and that's something that you would want to do to study proxy contests. The votes of shareholders beyond mutual funds and management, which you can probably easily predict, are generally hard to observe. So a couple of papers that I list here have studied the votes of public pension funds, either from state public records or Proxy Insight. And there are 2 interesting papers that look at retail investor base votes, but these data is generally not publicly available. Finally, if you're interested in the implementation of proposals, so as I mentioned, several researchers have collected this data, and usually companies report this in subsequent proxy statements as well as 8K forms. And you can look at the details in these papers of how this is done. Great. So let me now go to the main part of the lecture and talk about the 2 key roles of shareholder voting. And I will start with voting as an aggregation of information. But let me start first by just talking about both of these roles. So think of a proposal such as the quite well-known proxy contest when engine number 1 ran a proxy contest in ExxonMobil and actually won a few board seats on that board. You can think that there is information about the value of this proposal, about whether the activist strategy is in some sense better than management's, that is dispersed among shareholders. And voting could be a way to aggregate this information. So that would be one function of the vote. Another function of the vote is to aggregate heterogeneous preferences and views that shareholders may have. This is a proposal related to climate policies, and there is a lot of heterogeneity in shareholders' views on that and preferences. So another important function of the vote is to aggregate those heterogeneous preferences. And I will talk about both of them and the evidence and mechanisms related to them. So let me start with voting as an aggregator of information. The idea when we think about why voting is a good way to aggregate information is the wisdom of the crowd. That when multiple agents, shareholders in this case, get signals about the quality of the proposal, and they're not all perfectly correlated, they get signals from somewhat, maybe correlated, but somewhat different sources, these errors that may have in their individual votes will cancel out, and the ultimate vote will efficiently aggregate information. So that's the idea of the wisdom of the crowd. So where can different shareholders, where do they get this information in practice? how do shareholders become informed about voting issues? Shareholders may communicate with management. There are a couple of papers talking about this. This does not have to be hard information that management cannot disclose to individual investors and not to others. It can even be soft information that would still be relevant for how shareholders should vote. Investors who actively trade in the company's stock may collect a lot of information just for their trading, but that information could also be useful for their votes. Stewardship teams often report talking to individual fund managers that specialize in a given stock. There are, of course, proxy statements that are filed by companies and other filings. And Peter Ilias, Michelle Lowry, and Jonathan Kolodimos has designed a way to look at how to measure how investors research these proxy statements. And finally, a very important source of information for shareholders are proxy advisory firms. So let me focus on proxy advisors next. Who are proxy advisors? The main function of proxy advisory firms is to sell research and vote recommendations on voting issues to shareholders, primarily institutional clients. That's their main function, but in addition, they vote in other services such as voting platforms for institutions to execute their votes and file their votes with SEC if needed. They provide ESG ratings on companies, as well as advisory services to corporations. In the context of the US, this is a very concentrated industry. There are two major players, Institutional Shareholder Services and Glass Lewis. Both of them have more than 1,300 institutional clients and cover many, many shareholder meetings across the world, not just in the US, but in more than 100 markets. So SS is older and a little bigger than Glass Lewis, but both of them are the two major players in this industry. So what type of, when we think about research and vote recommendations, what do they specifically provide to their clients? So let me show you an excerpt. This is from Glass Lewis's website. Glass Lewis provides some sample reports on its website. And this is a sample report from Glass Lewis website on Oracle for the regular shareholder meeting in 2022. The report and ISS reports are quite similar. So the report usually starts with an overview of all the proposals on the table. And here you can see there are director elections. Glass Lewis recommended in favor of some directors, withhold or essentially against other directors, as well as the executive compensation votes, say on pay, and ratification of the audit. So there will be a front page, right, summarizing all of the proposals and the recommendations of the proxy advisor, as well as some rationale. And then on subsequent pages of the report, there will be a lot of information that summarizes the rationale and facts behind these recommendations. For example, in this particular annual meeting, Glass Lewis recommended against the advisory vote on executive compensation. And so on pages 19 to 26 of the report, there are all the reasons why Glass Lewis recommended against. There is some summary analysis, comparison to peer firms, the analysis of different components of compensation, short-term, long-term, various risk mitigating policies, the pros and cons, the specific areas of concern. So that you will see definitely for compensation proposal, as well as for various contentious issues where more attention for shareholders is usually required. So what do we know in terms of the support of the proxy advisors for management? This is some data from Fabrizio's paper, as well as the data from Alon Graf's paper on proxy contests. And what we see is that generally these companies in regular and CNP and director elections, they are quite supportive of management, yet of course they do recommend against management in a sizable fraction of votes. Glass Lewis seems a little bit less supportive of management based on Fabrizio's paper for CNP and director elections. On the other hand, it's more supportive for management in proxy contests. But generally, what Fabrizio's papers also show is that they use quite different criteria and often disagree with each other, especially when one of them issues a negative recommendation. What do we know about the influence of these companies? So what we see in the data, and a lot of papers have shown this, is a very strong positive association between the recommendations of the proxy advisory firm, ISS especially has been researched a lot, and the outcomes of the vote. So just to give you a sense of the magnitudes, This is the data on say and pay proposals from our paper with Yao Shen. And you can see that upon a positive recommendation from ISS, 0 proposals failed of not reaching majority support, and the average voting support was 93%. In contrast, upon a negative recommendation, 13% of proposals failed to receive majority support, and the average proportion of votes in favor was only 69. So this magnitude is quite consistent across papers and generally across different types of proposals, this difference. Of course, when we see this strong correlation between votes and recommendations, what we want to ask is this correlation causal in the following sense? One model of the world is that there is some underlying benefits or drawbacks of the proposal that affects proxy advisors' recommendations, and then the proxy advisors' recommendations affect investor votes. Another model of the world that would be consistent with this positive association is that maybe proxy advisors are not influential per se, it's just both shareholders and proxy advisors reach very similar conclusions after analyzing the issues that are under the vote. Overall research, and I highlight some papers that talk about this, concludes that there definitely is a causal link. It's not just pure correlation between the two. For example, in my earlier paper with Yao, we used the regression discontinuity analysis to estimate about a 25 percentage point effect of ISS in the context of say and paid votes. So there is this influence on voting outcomes. Another type of influence that has been emphasized recently, both in Fabrizio's paper and in the survey paper, is the so-called agenda setting role of proxy advisors. Essentially, proxy advisors often affect which corporate governance issues and which companies investors focus on. For example, as you saw in the context of say and pay table I showed you, institutions will often only consider opposing management if one of the proxy advisors recommends against. Which issues are considered controversial is often set in some sense by proxy advisors. That said, they are usually developed in consultation with investors. So every year, these companies talk to institutional investors and develop these guidelines that they will be basing their recommendations on. So there are these two sources of influence, and the question is now, is this influence beneficial? And I will talk about both the pros and cons of proxy advisors and the influence that have been highlighted in the literature. Let me start with the investor's perspective. I think that shows very nicely one important benefit of proxy advisors. This is based on a survey of large asset management firms, where virtually unanimously, the survey respondents highlighted the value that they derive from proxy advisors digesting and normalizing vast quantities of data in a very short period of time. So what do I mean by that, and what do survey participants mean by that? If you think about institutional investors, and there is growth of institutional investors over time, so this is becoming more relevant, they manage very large diversified portfolios. And it may be very hard for them to monitor and make informed decisions on each individual company in the portfolio and each individual proposal in that company. And this is exacerbated by the growing complexity, length of proxy statements, and the number of proposals that appear on companies' agendas. So this is where proxy advisors are helpful because they essentially provide a relatively low-cost signal that is available to every investor at a relatively low cost. And in some sense, they have economies of scale in information production because they deliver the services that they create to all of the shareholders. And as we saw, right, the reports, they often provide a quite detailed summary of the data and the pros and cons of the proposals on the table. One other thing to have in mind is that smaller institutions, if we think what would they do in the absence of proxy advisors, they probably would not acquire any information on their own because of free riding considerations. They are too small for the cost of informed research or voting to exceed the benefits. And in that sense, when there is this low-cost signal, right, the presence of a proxy advisor can make their votes more informed as long as the recommendation is at least partly informative. A couple of other benefits that have been highlighted is that negative recommendations by proxy advisors can help shareholders screen proposals better. They attract information, and that can focus shareholders' research on specific topics, and in that sense, through this, encourage more information acquisition. Finally, another role that has been highlighted in a couple of recent papers is that these companies also encourage dialogue between firms and investors. They encourage companies to actually communicate with their shareholders and see what their views on various voting policies. So these are the benefits. Proxy advisory firms has also been criticized a lot. So what could be the concerns related to their influence? One concern that we talked about also in our paper is that there is a potential for crowding out. So there is this wisdom of the crowd idea when shareholders acquire information from different sources, but if there is one source of information that everyone buys, there might be over-reliance on this one source of information, and that might jeopardize the wisdom of the crowd. That is, in some sense, exacerbated by the fact that some shareholders may rely on proxy advisors for other reasons not related to information. For instance, as you can see from this quote from former SEC commissioner, based on some SEC guidance and rules, many participants felt that relying on the advice from the proxy advisory firm could be a litigation insurance policy, a policy that would help insure against litigation for voting practices. And that might also lead to over-reliance on this one signal and even something called robo-voting, when when shareholder just follows blindly the proxy advisory's recommendations. A few other concerns are related to the quality of advice. So first, some concerns have been raised about potential conflicts of interest. As I mentioned, these companies provide advisory services for corporations, and this is often criticized as a potential source of concern. And what we also talk about in our paper is ultimately we need to think about the fact that these companies are in the business of selling information rather than in the business of maximizing shareholder value, and that might have some important implications. Finally, also related to the quality of advice, concerns have been raised about the so-called one-size-fits-all approach in recommendations. So some have alleged that the proxy advisors issue recommendations that are not very specific to the companies, to the individual companies. And because annual meetings, this is just a feature of shareholder voting, annual meetings are very, very concentrated in two months. And a couple of papers have shown that because of this concentration, the quality may also suffer, and concerns have been raised about some inaccuracies in the reports because of that. So these are the trade-offs. Let me conclude this discussion of proxy advisors with a discussion of investors and companies' perspectives. So the same survey that I cited before, investors showed that 55% of respondents agreed that proxy advisors do help them make more informed voting decisions. And even though they do agree that they might be sometimes exposed to conflicts of interest, and less than a third agreed that advice is too standardized. Interestingly, from companies' perspective, there is a recent survey by Hein and Vance, who surveyed board members, HR executives, and compensation consultants. There are two views. On the one hand, boards do feel the pressure to conform to proxy advisors' best practices, this preemptive or exposed conforming, which many boards feel might be suboptimal for them. On the other hand, this survey also showed that many participants in general see proxy advisors as improving compensation practices overall by increasing transparency, accountability, and this dialogue between investors and management that I alluded to before. So these are the trade-offs if we think about the proxy advisors. What we can also ask in this respect are the recommendations and votes that are based on these recommendations ultimately informed? And let me show you some conclusions of the literature about that. There is a paper in the context of proxy contests or contested director elections by Alexander et al. That concludes, based on analyzing the price reaction to proxy advisors' recommendations, that assessed recommendations in proxy contests are informative, and not just about the outcome of the proxy contest, but also about the dissident's ability, so that there is information about the value of the proposal. And then Anna Albuquerque, Marianne Carter, and Galani, they have a paper studying compensation practices and say on pay recommendations by proxy advisors, showing they tend to be associated with future industry-adjusted operating performance of the company. In the context of shareholders following proxy advisory recommendations, what the literature concludes is that not all voters, definitely not all, blindly follow ISS. So Fabrizio in his paper has shown that the sensitivity of overall shareholder support to recommendations varies with the rationale that is, for example, expressed in the report, with the severity of concerns expressed in the report by the proxy advisor. Another paper shows that it also varies with whether ISS recommends in favor or against to a large extent. Iliv and Lowry show that large shareholders with large positions that generally are part of larger fund families also have less turnover or more long-term. They are much less sensitive to proxy advisory recommendations, which would be consistent with them doing independent research. And their follow-up paper also looked at the information acquisition through proxy statement, as I mentioned before. And then another paper by Gao and Huang concludes that this ability to vote in an informed way, which the authors vote by looking at the price reaction to the vote and whether your vote direction coincides with that price reaction, is quite persistent. So there are some voters who persistently vote in a way that is consistent with what the market thinks is the right way to vote. Finally, an important topic also in the context of proxy advisors is there a difference between passive and active fund managers? This is becoming more important with the growth and concentration in passive asset managers. Here, the literature generally concludes that passive fund managers support management more than active funds on the same proposals within the same firm. However, when you look at it a little bit more closely, that's what Alon Brav does with his co-authors in the paper on proxy contests, it doesn't seem, at least for the big three, for the large passive management, that it's complete passivity or lack of information. So it seems these shareholders are supporting management, but there could be good reasons for that. They could be voting based on information. Okay, so that's what I wanted to say about the information. Let me now briefly just conclude this topic by saying this is something that I would encourage more researchers to vote on, because I think it's very, very hard to study whether a vote of a shareholder or a certain recommendation is informed or not. And this is for a couple of reasons. First, the value of proposals that are voted on is realized in the very long term, and it's often very hard to trace the value effects, right, for a given proposal, given that their value is realized over the long term. And the price reaction to a vote are subject to various issues discussed in the papers. And the direction of the vote, so the literature has used votes against management or votes relative to ISS, may not always offer a clear signal of whether the vote is informed or not. And these are issues related to strategic voting, the strategic design of recommendations, as well as the selection of proposals that appear on companies' agendas, something that I mentioned earlier in my first slide. So if you're interested, there are a few papers talking about this, and we also talk about this measuring of informed votes in our survey on the governance implications of indexing. Let me now turn to the second role of shareholder voting, the aggregation of preferences. So by now, there is a very large literature that concludes that shareholders are heterogeneous in their preferences, and they're heterogeneous along multiple dimensions. One dimension that is quite salient nowadays is the social and political ideology of shareholders. And if you're interested more in this topic, there is an upcoming lecture by Pedro Mates, who probably will talk about at least some of these issues. The literature also has highlighted that investors differ in the governance philosophy, and the extent to which they think certain governance provisions are value increasing or not, and the extent to which they think they should be interfering in what companies are doing or not. The literature has studied potential conflicts of interest that might also drive heterogeneity of preferences. These conflicts could come from some business ties the company has with investors, whether the investor is affiliated with, say, labor unions, they may have some other connections with the company's management. And partly, these conflicts of interest could also come from different portfolio ownership. whether you have shares both of the target and the acquirer in the context of a merger, whether you hold both bonds and share equity, or maybe you are holding some derivatives or other securities that help you separate the cash flow and voting rights. Another important source of heterogeneity could be differences of opinion that have been explored in a couple of recent papers, and of course, time horizon and tax differences across investors. So all overall, we see shareholders are heterogeneous. What does it matter for votes if we want voting to aggregate these heterogeneous preferences? What we generally know, this is well known from the political economy literature, is that majority voting does not reflect the intensity of preferences. What does it mean? It means that if there is a majority who are relatively indifferent, who are very close to being the margin, and there is a much more intense minority, the indifferent majority will win. And of course, it depends on the objective function, right, what we want to achieve, but that's something that we must know, that majority voting does not reflect the intensity of preferences. In the context of corporate voting, we want to take into account the existence of financial markets. And financial markets are quite unique because they allow shareholders to actually reflect the intensity of their preferences through trading. That's something we explore in a couple of recent papers with Daron and Ernst. So if you think of a shareholder who likes the corporate policies of the firm and another shareholder who doesn't like the policies or the strategy of the company that is taking, they will have different valuations. Shareholders who like the firm will have high valuations. So that creates gains from trade and ability for shareholders who especially like what the company is doing to reflect, right, this intensity of preferences in their trading decisions. So trading would align the shareholder base with the firm's policies and views about management and make it more homogeneous. On the other hand, as we also highlight in the paper, removing frictions to trade is not always good because it can also allow shareholders with more extreme views to gain more voting power and potentially impose their view on more moderate shareholders. And ultimately, even though trading aligns the shareholder base, it will still be heterogeneous, right? There are various reasons why the firm will not be just held by one shareholder holding all of the shares. In this context, what we also highlight, and something I alluded to before, as long as the shareholder base is heterogeneous, it becomes quite tricky to look at the positive, to the price reaction to the voting outcome. Because in the context of heterogeneity of preferences, a positive price reaction to a voting outcome does not necessarily mean that the voting outcome is good for shareholders as a whole, for shareholder welfare. Just to also attract your attention, this is something I think this interaction between trading and voting is generally a not very explored area. There are some recent interesting theory papers that I listed here. It is quite underexplored empirically, I think, so I would encourage I think more research in this area if you're interested. What are other things we can think about in the context of preferences? So returning to the role of proxy advisors, how can they adjust their recommendations to investors' heterogeneous preferences? What we know, proxy advisors actually do offer recommendations that are customized to individual shareholders and are customized to their preferences and views about the optimal governance policies. First of all, both proxy advisors offer some off-the-shelf recommendations that a shareholder can subscribe to. You can see here, both ISS and Glass Lewis offer policies tailored for climate-focused investors or public pension funds or more management-aligned investors. So there are these different policies that shareholders can choose from. And in addition, proxy advisors also offer recommendations that are customized to the individual client. And I have a project with Eddie Hu and John Zitnik in which we explore this customization. And at least in our data, we see that 80% of funds use some version of recommendations that are customized to them. So this is becoming much and much more pronounced. So that's proxy advisors. Another important intermediary that becomes quite relevant when we think about heterogeneous preferences are asset managers. Asset managers are voting the shares on behalf of investors that hold the shares in the firm through this asset manager. So this is the default system, right? If you own shares in a company through, say, BlackRock, BlackRock will be voting this block of shares on behalf of all the investors who hold their shares through BlackRock. In recent years, given the growth and concentration, especially of passive owners, as well as growing disagreements about environmental and social issues, this system has come under a lot of debate. And actually, there is interesting research by John Zitnik showing that the ideology of the fund is often not aligned with the ideology of the underlying investors, except for environmental and social funds. If you think about ideology as measured by the propensity to vote for social and environmental issues. So this is leading to a lot of change in the industry. One change is the so-called move to pass-through voting. Pass-through voting is a recent phenomenon that talks about and allows investors who hold shares through the fund to now start voting the shares themselves, rather than delegating the voting decision to the fund as they have traditionally been doing. BlackRock was the first to introduce its voting choice program 2 years ago, where it offered its investors a choice: keep delegating the votes to BlackRock or start retaining the votes and voting themselves. And about 25% of eligible assets under management enrolled in this program. Other large asset managers followed, not just in the US, but also in other countries in the UK, and recently it was extended to retail investors. So this is something that I think is quite underexplored. It's driving a lot of changes. The data is not yet available, but we have a recent theory paper where we talk about the implications of pass-through voting and voting choice and highlight the trade-off between aggregating investors' preferences and the need to vote in an informed way. And one particular source of inefficiency that we highlight is that when investors will choose whether to retain their votes or continue delegating their votes to BlackRock, they will make these decisions for their own benefit, right? Thinking about their own preferences and not internalize the effects of these decisions on other investors. This, as we show, can make voting choice potentially inefficient, as well as the fact that if less votes are delegated to fund managers, they might have less incentives to become informed in the first place. Finally, one last thing I wanted to mention in the context of both pass-through voting and heterogeneous preferences is investor participation. If voting is costly, then investors who will choose to participate will more likely to be investors who feel very strongly about the issues, investors with more intense preferences. And that will affect, right, if voting is costly, that will affect in the context of preference heterogeneity what the outcomes will be. Such costs of participation are especially relevant in the context of retail investors. Institutional investors generally vote, they rarely abstain, but retail investors rarely vote. These are some numbers from the paper by Alon Rav, Kane, and Zitnik, showing that while on average 80% of shareholder base participates, retail votes are much less likely to participate, especially if we don't weigh them based on their assets, right? On the individual account level, only 11% of accounts participate. This can be very relevant if we think about pass-through voting. One of the proposals that is currently on the table in the Senate is the so-called Index Act, Investor Democracy is Expected Act, that suggests that passive funds cannot vote without instructions from fund investors, except for routine matters. And of course, we need to think, right, if voting is completely delegated back to individual investors, what the participation rates will be. In the interest of time, I will skip the slide on recent literature on environmental and social issues. You can see all the links to the papers, and this will be posted, and I will conclude. So overall, shareholder voting is a key channel of shareholder influence. And what I think makes it very exciting for researchers is that the voting landscape keeps evolving. There are regulations, there are institutional changes, heterogeneity in shareholders' preferences is becoming much more salient, and that leads a growth of important issues on its own. So we see a growth in environmental and social proposals that appear on agendas. These issues of pass-through voting and customized recommendations are likely to change the landscape. The other important sort of changes are coming from technology. The fact that pass-through voting is now possible is possible due to advancement in technology. And there are now various platforms that collect investors' preferences and even collaborate with asset managers to share those preferences. There is a move towards virtual shareholder meetings, which was sped up by the pandemic, but now this is something to stay, and that raises a number of important issues that are highlighted in these papers that I cite here. The fact that retail investors can more easily participate in the stock market and can also exchange their views through social media platforms leads to meme stocks and issues related to governance of meme stocks, including lack of retail participation. And finally, something that I would refer to the lecture by Wei Jiang, as well as the paper by Dave Yermak, is blockchain, something that a technology that can help address the very complicated system that we have in the context of proxy voting. Who owns the firm? Who is eligible to vote? It's a big mess, and there is hope that technology can help. And finally, there are all those regulations. We didn't talk about some of them, but all of them are changing the landscape of shareholder voting, and I think bring a lot of new directions for research. Thank you very much.
All right, so I think we open the Q&A session. We start with a couple of questions that were actually sent ahead of the presentation today. So one of them was on a topic obviously everybody's interested in, the environmental and social type of votes. And so the question was essentially, is that different from other, type of voting on governance? Is introducing some new dynamics? And also, what about the recent move towards the anti-ESG feelings and that affected voting as well in the last proxy season? So, what's your view on the ES-related voting?
Oh, that's great. That's actually the slide I skipped, so that's very relevant. So yes, these are definitely very relevant. Environmental and social issues are very much on the table, and the number of proposals from shareholders is increasing. I think in the year that I showed, there were about 200, about 40%, and it grew to almost 350 in 2023. So it's a huge growth in these proposals, and they form a significant proportion of shareholder proposals. I do think they are somewhat different from governance proposals. And if we look at the numbers, just at the statistics, I showed you about 44% average support rate for all shareholder proposals, governance and EMS proposals. This is mostly driven by governance proposals. Environmental and social proposals tend to receive much lower support rates. I think last year they were about 30%. This year, the support rate even declined to 20% or less, and very few of them are actually passing. Part of that lower shareholder support, I think, reflects this heterogeneity of preferences that I alluded to before. The shareholders are much more likely to disagree on these issues compared to what governance policy maximizes the utility for them. Part of the decline in support, something Fabrizio asked about, is at least attributed to some of the regulations that we haven't had a chance to discuss. So the SEC came up with some changes in how it treats shareholder proposals and which proposals can be excluded from the agenda. And in particular, it's much more lenient on proposals related to various social issues. That allowed many more proposals to be included, but that also made these proposals much more restrictive or prescriptive, as they are often referred to, and that decreased the support from major shareholders. And again, another thing I keep referring to is the selection, right? Major shareholders, they keep engaging with companies. So if there is a major issue, environmental and social, that major shareholders agree on, probably this will not be brought to the table in the context of an environmental and social proposal. And that's reflected in some recent research, one by Rina Agrawal and co-authors, and then Ronnie Michael and co-authors, who show that these discontent, even with environmental and social issues, it shows up in director elections and not necessarily in the support, like the propensity to see environmental and social proposals. Just shareholders express these their thoughts through director elections. Okay, I think that maybe let me just say one more thing. So these proposals do fail, but it doesn't mean that they don't matter. And this is because the support rates are still informative. So it's still shareholders do vote in an informative way. That's a recent paper by Hay, Karaman, and Lowry, which shows that greater support rates for these type of proposals, they are associated with more incidents related to that and greater effects of these influence on shareholder value.
Okay, and then there was a question on retail voting. You touch upon the fact that a certain percentage of retail shares are actually voted and the determinants of that percentage. And I think the question was a little more about what do we know about what influences retail vote? Does proxy advisors have an effect on the retail votes, or do we know what are the determinants of that? What is the main source of influence for that? Given that it's increasing in size, and especially with retail investors becoming, going to trading platform and perhaps starting participating in virtual meetings and these type of things.
Yeah. So proxy advisors per se seem less influential. It seems the main clients of proxy advisors are institutional investors. So the paper that I referred to, Bradkin and Zitnik, it shows there is a positive association with retail votes of proxy advisors' recommendations, but it's much, much smaller, probably 10 times smaller than the correlation with institutional investor votes. For retail investors, what seems to be the key factor driving their support is their attitudes towards management. And there is a paper, I didn't cite it because it's not yet publicly available, but there is a recent, very interesting paper by Jackson and Zitnik showing that for retail votes, really the views for management is what determines their voting across the board, even on environmental and social issues. And the views for management are determined to a large extent by recent stock price performance. So stock price performance affects both investors' views, also it affects which retail investors will actually hold the firm. So there is self-selection of retail investors into firms with management that they like, which is why we also often see a lot of very high support rates of retail investors for management. So proxy advisors as an intermediary are not very influential. One other intermediary that I didn't talk about in the talk are proxy solicitors. So when these are companies that are used by management as well as, say, by activists in proxy contests to solicit shareholders to vote. And there is research showing that management tends to use proxy solicitors a lot to encourage retail investors to vote, again, partly because there are such high support rates from retail investors for management, potentially due to their self-selection into companies they like.
And one of the questions, staying with the issue of proxy advisor influence, is saying, in view of your data on the fact that, a lot of the votes are cast based on custom recommendation that they prepare for, more than 80% are customized recommendation. Are we overstating the influence of proxy advisors based on, just looking at the benchmark, general recommendation? So are we overstating the influence?
Yeah. So I think at least I think what the question in the paper that I mentioned in 2011, we tried to estimate the influence on say on pay, and there we think the 25% percentage point effect in the context of say on pay is a quite precise proxy, but precise measure, but it might be changing. So that is 2011 data, and this customization is becoming much more prominent in recent years. So it is quite likely that the benchmark recommendations per se will become less influential. This is also actually not influenced by the pass-through voting that I referred to. When BlackRock or other asset managers allow their investors to withdraw their votes from BlackRock and retain the votes, one option that is usually used by investors who choose to do so is to enroll in one of those thematic policies by proxy advisors. So it is quite likely that the influence of benchmark recommendations could be decreasing over time, and we'll see more of that as they are becoming more customized and as pass-through voting is becoming more widely available.
Another question from, I suppose, from a researcher that is interested in this, and saying that, the literature uses the votes against management as a measure of active monitoring, but then he also uses the votes kind of against ISS recommendations as a measure of active monitoring. And when I assess a management diverge, which one is the measure of active monitoring? And so can you help us make sense of what to make of votes different from ISS when those votes happen to coincide with management? Are you a good monitor in that case, or are you not monitoring?
This is an excellent question. I definitely, like, that was the slide trying to exactly attract the attention, right? That these measures are imperfect, and indeed they often reach different conclusions. So we hope it would be a long answer. So we hope to talk more about in the survey. But a couple of things I want to highlight. So one is, for example, support for management. I talked about it before, but if we, something that Bravo Al highlight in their paper on proxy contests, large asset managers, they tend to support managers more than, say, small or like active funds. But if you look more closely, part of the reason is that the proxy contests where the large asset managers were not expecting to support management, they are just withdrawn by management. Right? They realize that it will not be getting the support, it withdraws. So in those votes that do proceed to a vote, there is more support, but it doesn't mean, right, that these asset managers are biased in favor of managers. Just whatever important proposals they did not support were not voted on in the first place. So this is an important issue. James Pinnington has a paper showing why, not giving another reason for why support for management may not be a good proxy. And then I have a paper with Nadya Malenko and Chester Spatt, which talks specifically more closely about the question that was asked, that disagreement with ISS recommendations in favor of management is not necessarily, or proxy advisors' recommendations in favor of management is not necessarily a sign of biased voting, if we think about the strategic design of recommendations. So I will refer the interested people to that slide and the specific papers mentioned on that slide that go there into more details.
Since I think we have only 60 seconds, I will finish with the most difficult question so that you have only 45 seconds to try to answer it, which is, where shall we draw the line about what should be voted upon, what should not be voted upon, what should be binding and non-binding? Is shareholder democracy something to encourage or not? So you have about 40 seconds to take this very small question.
Well, I think there is a legal question that I will not touch upon, right? And the law says in detail which votes should be in place, which votes should be binding or non-binding. And then there is the economic question, right? And that is something I can talk a little bit to, although it hasn't been researched. So that's something is not researched to a large extent. But something we looked at in the context of our paper with Daron on non-binding voting is this choice between binding and non-binding voting. And what we highlighted is that in some cases, non-binding vote, even though it's not binding for management, can actually be preferred by shareholders themselves to a binding vote due to the flexibility that it offers. Management, right, binding vote, it has a predefined threshold. Non-binding vote, as we show, are often effectively binding, but with a threshold that is very tailored to the specific company and proposal. And this flexibility can make non-binding votes potentially beneficial.
Let me finish in 1 second just to say there were a lot of good comments and suggestions also for your literature review in the chat. So I'm sure that June will make that available to you with a lot of institutional examples of the things we are discussing. So I apologize to the participants for not touching upon all of them, but I think you can follow up with Nadya if you like, and we will give her all those comments. And June.
Thank you very much to everyone. That's great.
Thank you so much for giving such a wonderful lecture. And Fabrizio, you are one of the most active moderators. Thank you, because you have done so much research in this area. So many of the questions and Nadya's answers touch on another area. We haven't scheduled any public lecture yet. So today I discussed a paper at the PRRA conference. This is Principles of Responsible Investment on the direct engagement of government pension investment fund. This is a Japanese largest pension. This is a universal owner, and they engage directly with companies through their managers. So actually through index inclusion and exclusion that directly influence the decisions of companies. So this is the other channel that shareholder voting, at least the vote put onto the agenda, and the outcomes may not be fully captured. So Nadya touch on some of that aspect. Maybe there should be a separate lecture talking more about that, so you will have a more comprehensive understanding of the issue of shareholders' voice. I know we could talk for a very long time, Tokyo time 2:15 now. So this QR code is for our next public lecture. This is about CEO activism. It's a very new topic, and Jason from University of Arizona will give us some interesting discussions. I hope to see you next month. If not, the recording is available. I know if you're in Asia, it's very hard to dial in. The recording, the slides, and also the speakers' answers to the Q&As will be posted on our website. And Nadya is still working on her review paper. Once it's available, I'm going to make an announcement on our website and post the link to that paper on our website as well. Thank you for attending today. Thank you again, Nadya and Fabrizio. Good afternoon, good evening, and enjoy the rest of your day. Thank you. Bye.